Now we're going to turn to Asia. And before we go deeper into China, we want to talk about Japan and some of the other nations in the region, just because there's some decent data sets that have come out recently. And looking at Japan, you had small beat on GDP. It was expected at 0.1, came in at 0.3%. Then when you start looking at the deflator side, it was supposed to be at negative 0.9, came in at negative 0.7. Again, all of these things moving in a fairly stable level and against the expectations. But then you start looking at industrial production month over month for June. You see a little bit of an improvement from 6.2% to 6.5%, starting to see that come up. But the problem comes when you start heading to exports and imports. Exports were expected to be at 39.4%, came in at 37%. So that's still very good, not a huge miss. The more concerning side is the imports miss. So the imports were at 35.3%, came in at 28.5%. So remember, Japan specifically is so it imports raw materials, semi-finished goods, exports the final product, or mostly semi-finished good. So that at that point, as imports are coming down, it just shows that there's going to be pressure coming forward on the export side, and we're going to see some of that reduction in general. Core machine orders month over month were expected to be down negative 2.8, came in at negative 1.5. Core machinery orders 15.6 came in at 18.6 year over year. So there's some growth. It's just we saw some slowdowns accelerate in July and continue in August. So June was kind of that peak month, and now we started to come down, which will start to show up. And I think the trade balance, exports imports are carrying that. And what we're starting to see in some of the other, when we talked about PMI, services, manufacturing, those are the things that we had talked about last week and the week before, which I think is, the exports, imports is starting to play out, especially on the import side. So then when we look at machine tool orders, this is where you can kind of see this slowdown, but we have to talk about the Japan Producer Price Index. So you can see here year over year at 5.6%. And then when you look at month over month, 1.1. It's now above where it was in 2019, and it's remained elevated. It's remained elevated and continues to drift higher. And just think about, again, they're an exporting nation. They're exporting to countries like U.S., and we're going to be importing these price increases. And then Japan might send it to Taiwan to get finished, or South Korea or China to get finished. And so as their prices go up, that's just another piece along the supply chain that is just moving itself up, again, driving more of that inflation as we go forward. But it's not just Japan. Look at South Korea's export price index. You can see South Korea is now at 111.2. Again, seeing these price increases just going higher is putting that additional pressure. So then when we look at India with industrial production, India, the expectation was at 14%, came in at 13.6. CPI was expected at 5.72, came in at 5.59. Better, a little bit lower, but industrial production came down. CPI still elevated, but not as bad. Exports were elevated at 49.9, but imports, which again, as we're talking about, was at 63%. Still going to see more of that flow through, but wholesale prices remain elevated. It's expected at 11.29, came in at 11.16. Again, seeing these prices, not so much in this specific instance as well, not shifting, exploding higher, but also not coming down all that much. So still maintaining this pressure that we continue to see remaining in the system. So then Indian industrial production, when you look at it over the last few years, just to kind of normalize things, you're just seeing where we're sitting right now, still below 18, 19, but again, still much obviously better than 2020. And then manufacturing production, right in line with where we were in 16 and 17, but still well off those highs that we saw in 19 and 18. So it just speaks to just some of those overarching problems that continue to reside throughout the Indian economy. Which is, again, this is just more data points of what we've been talking about with the slowdowns, with the pressure when we start talking about Indian GDP slowdowns and those pressures where estimates were just wrong. They had to be reverted lower, and this is that perfect example. So now just shifting into China. So first we want to talk about the communism push, because We've been talking about how Xi has been aggressively moving that communist bent, and I think it's important, again, to talk about it where President Xi puts China's wealthiest citizens on notice, outlining that common prosperity, which includes income regulation and redistribution. So what does that mean? So in Tuesday's meeting of the Communist Party's Central Committee for Financial and Economic Affairs, the government detailed new strategies to target the upper echelon. Officials vowed to strengthen the regulation and adjustment of high income, protect legal income, reasonably adjust excessive income, and encourage high income groups and enterprises to give back to society more. So what does this mean? So despite being ruled by a communist party, inequality in China is much more extreme than in other major economies, even though they like to say that it's not. But again, this is just coming from those data sets. Tuesday's meeting of the area, so let's just give some quotes. We want to create an olive-shaped income distribution where the middle is larger and the two ends are small. Xi's not pushing for government handouts, and instead he wants more equality of opportunity. We should encourage getting rich through hard work and innovation. We should increase the people's education levels and give more people the opportunity to create wealth. All fair and valid, which is part of the reason why when you look at what they're talking about with cutting private tutors, trying to level the playing field. But again, how much of that playing field is really leveled or tilted one way? But you could say the same about the U.S. in terms of being tilted one way versus the other. But don't you celebrate too soon billionaires, because when you look at soaking the rich is still there. We should strengthen the regulation and the adjustments of high income, fairly regulate excessive income, and encourage high income people and enterprises to give more back to society. There's also talk on inheritance. How does that shift in general? So since 2017, Xi has made reducing inequality a key component, which we've been talking about. We had segments called Communism Rising, highlighting the push, the reinstituting CCP training, making sure that people understand the education, the benefits of the CCP, Mao, how things came about. Reducing inequality makes a lot of sense. It's politically popular, and it should also help boost household consumption. Because remember, the dual circulation strategy is the focus. They want to drive consumption, but how do you drive consumption if households are struggling? So that's, again, they're trying to move that money into position. But when we look at at some of the shifts, the NDRC wants local officials to back off on climate goals. Why? Because they cost a lot. So we're starting to see some of these shifts. When it comes to decarbonization, the pendulum has swung too far. That's according to the NDRC, which called for a course correction on China's carbon crackdown, a desire to rein in surging commodity prices. China's net zero weekly look, again, you're starting to see some of these adjustments as there's a little bit of that panic. So according to Xi, so that's there's oversight that needs to happen. And so that's the environmental side. Now we want to look at the finance side. So according to Xi, finance is at the core of a modern economy and is closely related to development and security. We should adhere to principles of marketization and the rule of law in regards to prevention and resolution of major financial risks. So what are they trying to do? Consolidate the momentum of the post-COVID-19 economic recovery, resolve financial risks through high-quality development, clarify responsibilities of local parties, improve supervision of cadets or Communist Party, improve digital and AI supervision, promoting the punishment of financial corruption, giving further play to the role of credit and financial risk identification. So a lot of, some of it sounds good. Then you start mixing in Big Brother and you're like, well, how much Big Brother should play a role is going to be a very heated debate for the foreseeable future. But that's just, something to be considered when we're going forward. So now let's look at some of the things that we didn't talk about last week, but tie into some of the slowdowns that we've seen. So when we look at aggregate financing, the estimate was for 1.7 billion renminbi. It came in at 1 billion. New loans was expected at 1.2, came in at 1.08. Money supply continued to shrink. Again, pulling that excess out that we were talking about. So when we look at monthly money supply, you can see that things have leveled off or continued to shrink. So M2 had a little bit of an increase, but as we said, that increase was going to be reversed. And here's that reversal, where when you look at M1, it's been a steady decline lower as they're trying to mitigate against the triple R cut versus the excess liquidity that still remains within the system. So then when you take that aggregate financing, it still is well below 2020. Because remember, the goal was to be below 2020 to take some of that excess out of the system. Now, in some places, it's above, but in most places, it's either equal to or less than, which again is the main goal of what the PBOC is doing. Now, even though the economy is slowing a bit faster than they expected, you're starting to see that, questions come up about 6.5% even being doable. At this point, it's probably closer to 5.5%. They could easily panic and send this higher, as we said with the U.S. government, where GDP grew 12 trillion, debt grew 23 trillion. You need the GDP to grow above that debt, and that's again something that they're trying to attain. But you need to pull out some of that excess, which has led to a significant amount of fear when you look at bonds, when you look at new loans, at rates, when you look at spreads. Chinese spreads have gone way higher because there's more risk that's being priced in. And this is the loan demand from companies. As you continue to see, they're cooling off. Small enterprises, total loan demand, medium enterprises, large enterprises. The small and medium is the focal point that is going to happen because there will be another triple R cut. It's just going to be more segmented to target and help protect medium and small, because that's where they're struggling. There's CapEx slowdowns and they need jobs. And if you need household spending, you need jobs to give wages. So you're going to need CapEx expenditures. So this is going to be one to watch. Not so much large enterprises because they've been fine. It's going to be the medium and small, which is going to be that pivot point that I think the PBOC and CCP are going to target more aggressively with some future benefits. But it's going to be whittled down to a point because they're also going to try to offset some of that because they can't let liquidity get too far out of control, which is how you minimize large enterprise, try to target medium and small, and continue to take down other forms of easing. So now when we look at the most recent data sets, so the headline retail sales rose 8.5% in July, down from 12.1% year-over-year growth in June. But retail sales were expected at 10.9, came in at 8.5. Retail sales year to date were expected at 21.2, came at 20.7. Fixed asset investment fell by 0.8% compared with 4.7% year-over-year growth. But when we look at industrial production, was expected at 7.9, came in at 6.4. Fixed assets ex rural was expected at 11.3, came in at 10.3. When you look at property investment, came in at was expected at 12.9, came in at 12.7. Survey jobless rate was expected at 5%, came in at 5.1%. All of that is just additional slowing. We keep seeing these pressure points, and it's actually worse than what they're saying, and we're going to talk about that on how things have gotten worse. So when we look at value-added output at industrial firms rose 6.4% in July versus 8.3% growth in June. All of these are just falling well below that GDP target, and without something making a big snapback up, there's not going to be a way to close that gap and hit that targeted rate, which again comes back to why are they shutting ports down? Are they trying to build a natural scapegoat for where some of these things are? And is it going to drive them to try to have a common enemy, which could be the U.S.? So if you start looking about Taiwan and some of these shifts in geopolitical moves, they've been running additional pressure points into EEZ zones. And again, these are things to consider. But there's also the underlying problem of debt. So Evergrande needs to repay $7.4 billion of maturing bonds next year. So this is just an example of where these pressure points continue to reside. And we're going to talk about that in a second in terms of how that spread has continued to grow between the U.S. and China, to give you an idea of where some of these rates are and how debt is becoming more expensive. But first, we want to talk about some of the absurdity in the data sets. So the first one is investments in fixed assets from January to July 2020. So that came out to 32.9 billion yuan, a year-on-year decrease of 1.6%. So then we come to July 2021. The national fixed asset investment, excluding rural households, same as before, was 30.25 billion yuan. So it declined. It went from 32.9 in January to July of 2020 to 30.25 January to July 2021. But fixed asset investment, when you look at it, should be negative 8.82%. But the NBS, or the National Bureau of Statistics, has a year-over-year growth of 10.3%. So instead of being negative 8.8%, it's positive 10.3%. But this is, so they keep, and we talked about this last year, they keep taking down and reweighting numbers lower previously in 17, 18, 19, 20 to show year-over-year growth. But that also means that that GDP number should also come down. So again, you're seeing some of these pressure points where, again, the numbers can get funny, especially when you start doing some of the deep dives. So then when you look at China consumer price inflation, things have been a little bit, let's just say fairly flattish when we look at non-food. Non-food, food has come down. That's as we talked about, is coming back up. But then non-food, consumer goods, you're seeing some of these pressure points. But remember, there's a huge disconnect in China between PPI and CPI. Well, PPI is much higher versus CPI, with a huge disconnect, because they're trying to take those increase in prices and push them offshore and avoiding pushing them down to the consumer, because again, they're trying to drum up consumption. They're trying to drum up that household spending. And they're trying to protect prices, which is why they've released some raw materials from strategic reserves, trying to bring these prices back down and mitigate some of this underlying inflation. But then when we look at some of these red flags, so yield to maturity, Chinese high yield bonds, you can see just where things sit versus the US. And this is all really stemming from this uncertainty. High yield corporate bonds issuance in China, you can see has started to come under pressure. Chinese companies have dominated Asia's junk bond market in recent years, but has started to slow. High yield corporate default rates, just look at where Asia is versus the US. Asia has continued to move up, a lot of that driven by China. So when you look at what are the yields, well, companies, coming back to companies and their movements, they're like, well, do I really want to issue more debt given where bonds are, or do I want to kind of wait a little bit longer? And that's where we're starting to see some of these different pressure points that continue to happen within the underlying Chinese economy, which is making debt more expensive, which is why they're aggressively going over after Evergrande and you're wrong, and all of these other companies to try to rein in debt, to try to show control. Because investors are panicking of, what is my waterfall? What is my recovery value? And if I don't know my recovery value, and say, for an example, I can say, okay, well, bonds are trading at 30 cents, but based on this waterfall event, I'm going to make 54 cents. So I'll buy the debt, I'll provide some liquidity, and then in that turnaround period, I'm going to collect, some of that will be equitized, and I'm going to make that spread between where their value of the company is. When you have assets mysteriously being moved into this government agency or this local company, it becomes difficult to value, and investors would rather just say, I'm avoiding it, I'm not going near it, this is too much risk. So those are things that they're trying to address. All the while, provincial breakdowns, when you look at Henan, you see that they are facing the most corporate defaults. And this is when you start looking at SPBs or special purpose bonds or LGFVs or those government vehicles. There are those problems of, how do you manage this debt with all these problems, especially given where there's been a significant amount of rainfall, a lot of flooding, a lot of crop destruction, which is just going to put more pressure on some of these provinces that are already facing rising default. And this is just putting Chinese retail sales in perspective. When you look at that deceleration month over month, this is what we're looking at in 2021. Because when you talk about Chinese GDP, how are you going to obtain at least 6.5% if this is your data set, if this is what is things are facing, and given July is typically slow, so there's some seasonality, but look at the trend in general as pressure continues to mount. And industrial production, this is what we've been talking about, where industrial production was going to come under pressure given there's already a backlog of orders. There's already a backlog at the port. So there is a breakdown at the actual manufacturer where I can't produce because I don't have raw materials. So if I don't have raw materials, I can't produce. And if I have inventory that still hasn't left the port or been taken from my facility to the port, how can I keep my industrial production moving? And these are some of those headwinds that reverberate back through the supply chain. So then China new home prices, another thing that they've been targeting, continues to come down, continues to decline as they try to, again, push affordability, try to rein in some of this debt, try to rein in some of the development and projects, which is becoming a bigger focus. And this is just looking at things over that time period of just how that deceleration has continued on sales value. And again, value versus volume is the key here because value hasn't gone up as much when you look at inflation. So you're still seeing that volume drop off, which again speaks to some of those additional pressures that continue into the system with the value added of industrials, which again, moving in the wrong direction when you're looking at growth. So then PPI minus CPI, this is just looking at what we just meant. It's the widest gap in 31 years. So the PPI is they're trying to export as much of that as possible to protect against, again, the local populace, which continues to struggle, and as they try to drum up more local consumption. Which, when you look at monetary conditions, when you look at how are they easing, well, look at the 10-year government bond versus the US CNY. Monetary conditions, this is what we've been talking about. They want things to stop going down, but they don't want them to pop back up. It's how do they maintain current monetary conditions without saturating the market and promoting these debt levels. And that's where we continue to see this work down as, okay, triple R cut, but then we're going to offset it by letting some of these loans expire. Again, these are things that they're trying to actively manage, which then when you look at the cumulative issuance by Chinese companies in the global market, gives you an idea of how much debt has come into that market over time. And a lot of it is investment grade. So how much of it should be investment grade? And that's when you start to see some of this balking of, well, it's IG, but can I really treat it as IG versus, and then the high yield continues to get more expensive. And then that's when you look at the unsustainable divergence between the commodity prices. So again, they've released commodities prices. They've released commodities to try to bring these prices down while things slow. So China manufacturing PMI has come to essentially a standstill, which is going to pull down some of these prices, which again have run well ahead. But it's a matter of where the price is going to come down, because coal has a lot of support. Copper has a lot of support. Steel within the U.S. has a lot of support. Crude has some stability right around this 65 level before it takes another leg down. So there's going to be something to watch as we go into the end of the year. But when you start taking this all together and you start looking at training and trying to get the populace re-engaged, I think it's important to look at the unemployment rate in China, because when you look at some of the anger that's just beneath the surface, some of the slowdowns, the youth jobless rate was more than 3 times the overall rate, which ticked higher to 5.1%. In July, and was the highest reading since the Statistics Bureau started releasing data for this age group. China aims to create more than 11 million urban jobs, because when you look at jobless rate for 16 to 24-year-olds, it's at almost 17%. That is a big problem when you look at 17% versus 5%. These are the people that, when you look at training, when you look at new training facilities, reinstilling the party's values and the CCP, this is what they're looking at. These are the individuals that they don't want to get disenfranchised, because that's where the uprisings would come down to. This is what was appealing and why Taiwan is fearful, it scares them. Why Hong Kong? When you look at some of these democratic moves, some of these pivots where they don't want this ideology to creep into people's heads that are unemployed and disenfranchised. So again, these are some of those pivot points that we like to talk about. And that's why when you're doing stuff on China, you have to look at what is the government doing, what are their new policies, because typically there's a problem that isn't known yet, or it's known, but it's not really known. It's kind of kept in the back end. And this is one of them. Like last year, you're pushing more communism training. You're pushing more party involvement. You're trying to, and given that, that we're coming into a very important symbolic period of the CCP creation, but this is also something to watch. So again, a lot to cover. So if you have any questions, again, you know where to find me. You can email me at Mark Rossano, or I should say M Rossano at c6capitalholdings.com, at MarkFNY on Twitter, or you can just reach me in the comment section, as I always like to get some of this back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.